Hello everyone, I'm Sung Lee and here we are with the third video series of the year. A quick heads up, I'm not a licensed financial advisor and my goal is to empower you with information, not to tell you exactly what to do. Always double check any information you hear, including mine, and make sure it aligns with your personal financial goals and situation. Remember, you're the driver of your financial journey, and these are just helpful tools to put in your toolkit. So, with that out of the way, let's get started on mastering your finances together. The Mastering Your Finances series topics come from my book, The Money Manifesto, Building Wealth and Keeping It. Today, the topic of discussion is Establish a Saving Account in part one of the book. Let's kick off our exploration of building your savings account with a powerful tool called high yield checking accounts. What are high yield checking accounts? These accounts are a relatively new innovation in the world of traditional checking. They offer a significant advantage with higher interest rates compared to what you'd earn with a standard checking account. The benefits are this checking account actually earning you money. With a high yield checking account, your deposited funds accumulate interest over time. This means your money is actively working for you, even as you use your debit card for everyday purchases. These accounts are federally insured by the FDIC for up to $250,000 per depositor. This means your money is protected in case of a bank failure. Your funds are readily accessible through withdrawals or transfers. This makes them ideal for short-term savings goals or building an emergency fund. There are some drawbacks to consider. While high-yield checking accounts offer a clear benefit, it's important to understand some potential drawbacks, such as it may require a minimum balance. Many high yield accounts have a minimum balance requirement. If you fail to maintain this minimum balance, you might forfeit the interest earned or even incur fees. Some high yield accounts may limit the number of debit card transactions or ATM withdrawals per month. So be sure to understand these limitations and ensure they aligned with your spending habits. These high-yield checking accounts are a great fit for emergency funds, where you can park your emergency fund while earn some interest while still maintaining easy access to the funds in case of an unexpected need, or for short-term savings goals, such as saving for a vacation, a down payment on a car, or any other short-term goal can benefit from the interest earned in a high-yield checking account. Remember, high-yield checking accounts offer a great way to earn extra cash on your everyday money. However, they might not be suitable for everyone. Consider your spending habits and the accessibility needs for your savings goals before choosing a high yield checking account or a high yield saving account. Now, you can open up a high yield checking account anywhere with online checking or online saving accounts. They tend to offer a higher interest rate than your traditional local banks. Traditional savings accounts have been a cornerstone of personal finance for decades. They offer a safe and secure place to store your money, separate from your everyday checking accounts. Similarly to high yield checking accounts, They are easily accessible and FDIC protections for up to $250,000. While the interest rates on traditional savings accounts are typically lower compared to high yield options, you still earn a small amount of interest on your deposited funds. Similarly to high yield checking accounts and high yield saving accounts, these accounts are ideal for emergency funds and short term savings goals. While traditional savings accounts offer security and accessibility, the interest rates might not be the highest. They are a great starting point for building your savings habit, but you might find other options for long-term savings goals where higher returns are potentially achievable. Currently, there are high yield checking accounts and high yield saving accounts offering up to 5.7% or 6% interest rates. So, in general, the traditional savings accounts are inferior to high yield checking accounts and high yield savings accounts when they serve the same purpose. Let's explore an option that offers a guaranteed return on your investment: certificates of deposit. What are CDs? A CD is a time deposit offered by banks and credit unions. You commit your money for a fixed term, such as 3 months, 1 year, 5 years, in exchange for a guaranteed interest rate. This guaranteed rate is typically higher than what you earn with a traditional savings account. Unlike a traditional savings account with fluctuating interest rates, CDs offer a locked-in rate for the entire term. You know exactly how much interest you earned on your deposit. But generally, CD interest rates are higher than traditional savings accounts. The longer the CD term, the potentially higher the interest rate you can secure. There are some drawbacks to consider. If you need to access your money before the CD matures, you will likely face an early withdrawal penalty. This penalty can significantly reduce your earned interest or even eat into your principal amount. CDs come in various terms, ranging from a few months to several years. The term you choose impacts the interest you earned. Shorter term CDs, they typically offer lower interest rates but provide more flexibility in case you need to access your funds sooner. Longer term CDs generally offer higher interest rates due to your commitment for a longer period. However, ensure the term aligns with your savings goals to avoid early withdrawal penalties. A strategy called laddering involves investing in CDs with different maturity dates. This allows you to access a portion of your money periodically while still benefiting from potentially higher interest rates on longer term CD. We will dive deeper into the laddering strategy later in the presentation. U.S. Treasury securities are debt instruments issued by the U.S. government. Think of them as IOUs by the U.S. government. Considered one of the safest instruments available, hence I listed them under savings account options. The U.S. government is highly unlikely to default on its debt, making Treasury securities a low-risk investment option. This translates to a high degree of security for your principal investment. Treasury securities come in various maturities, catering to different investment goals. Let's start with Treasury bills, also called T-bills. These are short-term debt instruments with maturities ranging from a few weeks to 1 year. T-bills offer interest paid upfront at a discount. So you purchase them for less than their face value and receive the difference at maturity. For an example, let's say you buy a 12-week T-bill with a face value of $1,000. You bought the T-bill with a discount rate of 5%. This means you pay $950 for the T-bill instead of the full $1,000. When the T-bill matures after 12 weeks, you will receive the full face value of $1,000. The difference between what you paid, $950, and the maturity value of $1,000 is your interest earned, which equals $50. In this case, your effective interest rate works out to be the same 5% discount rate you received at purchase. So while you do not get an upfront interest payment with T-bills, the discount you receive at purchase effectively functions as your interest earned when the T-bill matures. Next, we have Treasury notes, also called T-notes. These are medium-term debt instruments with maturities ranging from 2 to 10 years. T-notes pay interest semi-annually, twice a year, at a fixed rate. Treasury bonds, or also called T-bonds. These are long-term debt instruments with maturities ranging from 20 to 30 years. T-bonds also pay interest semi-annually, generally offering higher interest rates compared to T-bills and T-notes due to their longer maturity. Some key consideration to think about is the interest rate risk. This refers to the potential impact of changing interest rates on the value of your Treasury securities. We will discuss this concept further in a later segment. Savings bonds are another debt instrument issued by the U.S. government designed to promote saving and offer some unique features. There are two main types of savings bonds. The first one, we have the I bonds. These bonds offer an interest rate that adjusts based on two factors, inflation rate and fixed rate. The inflation rate is the interest rate protects your purchasing power by keeping pace with inflation. A fixed, a fixed rate is also added to the interest, providing a guaranteed return on your investment. Next, we have EE bonds. These bonds earn a fixed interest rate throughout their maturity. You can cash them out after a holding period, typically after 12 months. However, there's a bonus incentive if you hold it for at least 12 years. I'm sorry, 20 years. Cashing out an EE bond before it matures might result in a penalty on some of the earned interest. If you hold an EE bond for at least 20 years, you will receive a bonus interest rate on top of the fixed rate you earned. There are purchase limits on savings bonds to ensure everyone has a fair chance to participate. You can also enjoy some tax advantages, such as if you use the interest earned on savings bonds. Let's take a look at this chart comparing I bonds and EE bonds. The max annual limit to purchase I bonds and EE bonds is $10,000. They both matures in 30 years unless you cash it out before then. 12 months is the earliest you can cash out. The rates for I bond is fixed rate plus inflation rate. Rates for I bond issued between November 1st, 2023 to April 30th, 2024 is 5.27, which includes a fixed rate of 1.3% and an inflation rate of 3.97%. Your fixed rate will always stay the same, but the inflation rate is adjusted semi-annually. For EE bond issued between November 1st, 2023 to April 30th, 2024, the rate is 2.7%. For taxes, you only pay federal tax for I bonds and EE bonds. There are no state or local taxes. There are unique considerations for I bonds and EE bonds. With I bonds, you can cash out or redeem your I bond after 12 months. However, if you cash out the bond in less than 5 years, you lose the last 3 months of interest. For example, if you cash out the bond after 20 months, you get the first 17 months of interest. I bonds protect against inflation. You earned both a fixed rate of interest and a rate based on inflation. The rate is reset twice a year. Fixed rate is an annual rate. Inflation rate is a 6-month semi-annual rate, but shown as an annual rate. It usually changes every 6 months based on the inflation. EE bonds guaranteed to double in value in 20 years. You can cash out after 1 year, but if you cash out before 5 years, you lose 3 months of interest, similar to I bonds. EE bonds rate is shown as annual rate, but changes semi-annually. It also guaranteed to double in value in 20 years, regardless of rates. We will discuss more about EE bonds and how it does not take a high interest rate for your investment to double in 20 years, like EE bonds. This is the fun part. Let's explore a strategy to optimize your returns and access to your funds called laddering. What is laddering? Laddering is an investment strategy where you invest in CDs, T-bills, T-notes, T-bonds, I-bonds, or EE bonds with different maturity dates. Laddering offers several advantages. They offer predictable access to funds. By having your savings accounts with various maturities, a portion of your money matures periodically. This provides you with predictable access to your funds at regular intervals. Also, it offers a potential for higher returns. Laddering allows you to take advantage of fluctuating interest rates. As interest rates rise, you can reinvest maturing accounts into potentially higher yielding terms with longer maturities. This helps you maximize your returns over time. You do have to consider the investment horizon. You have to match the ladder's maturity range to your investment goals. How CD laddering works. Let's take a look at an example. Imagine a ladder. Each rung represents a CD with a specific maturity period. For example, imagine you have $6,000 to invest. You can ladder your investment by purchasing one CD with a 1-year maturity worth $2,000, maturing in 1 year, one CD with a 2-year maturity worth $2,000, maturing in 2 years, and one CD with a 3-year maturity worth $2,000, maturing in 3 years. This way, every year, each CD matures, providing you with access to a portion of your funds. As interest rates rise, you can reinvest the matured amount into potentially higher yielding CDs with longer terms. You can apply these concepts to savings vehicles with maturity terms. Like I mentioned before, you can apply this concept to any savings vehicles with maturity terms. Let's see how laddering will work with EE bonds. Remember, if you invest in EE bonds, they guarantee to double the value after 20 years. Let's say you invest $10,000 every year starting in 2024 for 10 years. In 2044, when your first EE bond doubles in value, you can withdraw $20,000 every year for the next 10 years. This way, you are essentially creating a pension fund or annuity for yourself. You can create a longer or shorter ladder to fit your goals. You can use laddering strategy for any savings options with maturity terms. When dealing with savings vehicles with different interest rates that do not guarantee doubling like EE bonds, the returns will be different based on interest rates. Most likely, the returns will be better than EE bonds due to the risks of fluctuating interest rates. In order for $10,000 to double to $20,000 in 20 years, like the EE bonds, the interest rate would be around 3.55%. However, if you invest in saving vehicles that earn at least 3.55% or more, like some high yield savings or checking accounts, then your investments will give you a return of at least double or more of your initial contribution after 20 years. Remember, interest rates do fluctuate, so it could be more or less than 3.55% interest rate. Therefore, some people prefer the safety of EE bonds guaranteeing to double in value in 20 years, regardless of the interest rates. As we move towards long-term financial planning, let's briefly discuss annuities. I do not know much about annuities, but these are retirement savings vehicles offered by insurance companies. I personally do not like to mix my investments with insurance companies. So, what are annuities? Annuities are contracts between you and an insurance company. You invest a lump sum of money initially or over time, and in return, the insurance company provides you with income payments in the future, typically during retirement. There are various types of annuities available, each with its own features and benefits. Some common types include fixed annuities. They offer a guaranteed payout based on a fixed interest rate. Variable annuities, these are tied to the market, the stock market, offering the potential for higher returns, but also carrying the market risk. Immediate annuities, they provide you with income payments starting shortly after you purchase the annuity. Deferred annuities, they grow your investment over time and start providing income payments at a later date. It is important to understand that annuities can be complex financial instruments. They often come with fees and surrender charges if you withdraw your money before a certain time. Annuities can be a valuable tool for retirement planning, but they are not suitable for everyone. Before considering an annuity, it's crucial to conduct a thorough research and understand the specific features, fees, and potential risks involved. Consulting with a financial advisor can be highly beneficial to determine if an annuity aligns with your retirement goals and risk tolerance. Let's address some important considerations when choosing savings vehicles. Interest rate risk. It is important to be aware of interest rate risk, particularly when investing in bonds. When interest rates rise, the value of existing bonds, especially longer term bonds, can decrease. This is because investors can purchase new bonds with higher interest rates, making older bonds with lower rates less attractive. Interest rates act like a gas pedal for the economy. Lower rates make borrowing cheaper, putting more money in circulation and boosting spending. This can lead to faster growth, but also inflation. Higher rates slow things down by making borrowing expensive, which can curb inflation but also stifle economic activity. Liquidity. This is consider how easily you can access your savings. Some options like high yield checking accounts offer easy access, while others like CDs might have limitations or penalties for early withdrawal. Choose savings vehicles that align with your short-term and long-term goals, ensuring you have the necessary accessibility when needed. Third, risk tolerance. Your risk tolerance refers to your comfort level with potential investment losses. Some options like Treasury securities offer a high degree of safety, while others like stocks might offer a potential for higher returns but also carry greater risk. Choose savings options that align with your risk tolerance to ensure a comfortable and balanced investment strategy. Building your savings powerhouse requires careful planning and understanding your financial goals. Consider the factors of interest rate risk, liquidity, and risk tolerance when selecting the most suitable savings vehicles for your situation. Let's recap the key takeaways. High yield checking or savings accounts earn interest on your everyday money while maintaining easy access. Consider minimum balance requirements and transaction limitations. Traditional savings accounts, a secure and accessible option for emergency funds or short-term savings goals. Interest rates are typically lower than high-yield accounts. Certificates of deposit. Lock in a guaranteed interest rate for a fixed term in exchange for limited access to your funds. Early withdrawal penalties apply. Consider using laddering strategy for potential flexibility. U.S. Treasury securities. They are highly safe investments with varying maturities. Interest rates may be lower than some other options. Be aware of interest rate risk. Saving bonds. Another government-backed option with inflation protection, such as I-bonds, or fixed interest rates, such as EE bonds, that guarantee to double in value after 20 years. And consider their purchase limits and tax advantages. Laddering strategy. This is to optimize your returns and access to your funds. Remember, the best savings vehicle for you depends on your individual needs and goals. Consider your short-term and long-term financial objectives, risk tolerance, and accessibility needs when making your choices. This presentation serves as a starting point. I encourage you to conduct further research based on your specific financial situation, explore online resources, consult with a financial advisor, and choose the savings vehicles that best suit your path to financial success. You can visit drofcredit.com to find a list of high-yield savings accounts offering up to 5.8% APY. And to buy bonds, EE bonds, T-bills, T-notes, and T-bonds, you can go to treasurydirect.gov. If you have any questions, please submit your questions to info@sidewayup.com or add them to the comments section below. If you haven't already subscribed to my email list, add your email to the list on my homepage at sidewayup.com. Please subscribe, like, comment, and share with your friends and family.